Alrighty, folks, a little 2-for-1 action here tonight. First, we're going to react to this video here, which I'm excited to watch. The real recession will be in 2023, so we're going to react to that one there. And then we're going to react to this video here. No way the U.S. is avoiding recession. So I want to hear both these perspectives, gives my opinion on it. Thank you, everybody, for joining me. As always, we are approaching 7,000 subscribers now on this channel, which is absolutely massive because it's a pretty dang new channel. So I appreciate all the new folks joining us over here for these reactions, and yeah, let's watch this and let me give my opinion on this.
Some of the leadership that we've seen over the past month or so has really...
Okay, wait a minute. Who still uses one of those? Come on, man. This is 2022.
That the speculative fervor is back in, and that investors are suggesting that maybe the Fed goes to the sidelines. Let's go speculate again. It's 2018, 2019 all over again. Let's go have a good time. I think that's a mistake. I think if the Fed steps aside, it's going to be because the economy is an awful lot weaker than people think, not that we're in some kind of Goldilocks environment.
You know, there definitely has been a sort of echo boom.
Okay, this whole perspective on like, oh, everybody's just going crazy in the market again, man. It's madness. And, you know, I look out to a lot of stocks. I'm like, where, other than maybe a few of the meme stocks, like, I don't know, like AMC and the whole BBBY, you know, Bed Bath & Beyond situation, outside of a few of those, it's like, where's the real action at? I mean, all the other stocks are still down like 70, 80, 90%. So I don't know, this whole like, oh, there's some massive euphoria in the market. I'm like, I'm just not seeing it. I'm not feeling it. I'm not hearing about it outside of maybe like two like meme stocks. So that's about it.
The more speculative areas of the market. But to me, it looks like a lot of stocks down 80% have doubled off the down 80% level. At the same time, you know, Apple has been one of the leadership stocks, certainly quality, even if it's expensive. And you know, things like industrials working too. So there's a cyclical message that at least is being attempted to be conveyed by the market. Is that something you think is a bit of a trap, or is that okay?
The reason Apple's doing so good, by the way, is because people are still very scared of the market. When I say people, I mean Wall Street investors. So they're like, well, if I'm going to put money in the market, I'm going to put in Apple stock because they feel like that is the safe place to put money. So that's why Apple's doing so well as far as the stock price goes.
Well, Mike, I think that we're in some kind of a late cycle environment here. This is not the beginning of anything. We're in a late cycle environment, and I think that there's only two certainties as we look out towards the second half of this year into early next year. And certainty number one is the Fed's going to be tightening. Certainty number two, perhaps even more important, is that profits are going to be decelerating. So the question for investors is what works in that environment, right? There's a million different issues that are hair on fire. I know I shouldn't be saying that given my paint, but there's a million issues, but there's only two certainties. And I think the question is what works in that environment? The answer is actually defensive sectors, not growth, not cyclicals, but the one that people tend to ignore, which is defensive sectors.
And those have held up very, very well this year, to be quite honest. And, you know, he makes a point there about deceleration of earnings potentially. And it depends, you know, if you're going to look on a year-over-year basis, maybe. But, you know, you look at something like Target just reported recently, okay? Target earnings down 90% year-over-year. Well, guess what? On a sequential basis, they're going to likely show major growth in earnings next quarter, actually, like massive growth. I mean, when you come off of a disaster quarter like that, it's not hard to put up, you know, numbers that blow those numbers away, right? So on a sequential basis, it's going to make it look like, oh, things are getting a lot better for this company, even if year over year down. So that's where it adds to this whole confusion. And it's like, well, do you want to look at more of like a sequential basis, a quarter over quarter, or do you want to look more of a year over year? And it depends. Sometimes Wall Street wants to look at sequential. Sometimes they want to look at more year over year, right? So,
and those that you prefer right now would be just the traditional defensive sectors like healthcare, staples, things like that?
Exactly. Mike, the most boring stuff you could think of, you know, foods, beverages, household products, healthcare, utility stocks. I mean, it's pretty boring stuff.
You were ahead
which is where most people have been hiding out in honestly in this year in 2022. Like if you watch the market, which obviously we watch the market every single day on this, you know, on the main channel, every single day, what was the thing that happened every single day, basically the first 6 months of the year? Every single day, you know, it was growth stocks down. and it was like healthcare and consumer staples and, you know, utilities and these sorts of things were either up or doing halfway decent. So like this has kind of been the playbook this entire year up until maybe the past 2 months when things have at least a little shifted here.
The discourse, let's say a couple of years ago, in saying that inflation was going to become an issue, it clearly did. It clearly was not transitory in the way that Fed officials and many economists were saying it might be. Do you think now, though, that we're on the other side of that and that at least there's some downside momentum in inflation or not?
Well, thank you for pointing that out. I've had my share of faux pas too, but I'll take this one. And I think the Fed is historically behind inflation. If you look at the real Fed funds rate, meaning Fed funds minus inflation, no matter what measure of inflation you want to use, you're going to find that real Fed funds rate is still historically negative. That argues that inflation will be more stubborn. Is it peaking out? Perhaps. But is it just going to fade away? The real Fed funds rate argues it's not, and that it's going to be a more persistent and stubborn issue than people think. So I think where people may have it wrong in thinking that this little mathematical recession that we've had in the first and second quarter this year is the recession. Personally, I think the recession is going to be next year. The real recession is going to be next year, and that's because the Fed is likely to over-tighten at the same time profits are decelerating.
That's my, what he just explained there is my main fear about the Fed, because we obviously know the Fed went, way too crazy, and it wasn't just them; it was the government. You can almost put all these things together: the government, the Fed, whatever you want to say, right? Obviously they went way too insane in the end of 2020 and into 2021, right, with stimulus and all the different programs that were out there. But my main fear is in terms of really hurting the economy if the Fed over tightens and just continues to kind of ramp up interest rates. In my opinion, inflation will take care of itself because when you think about it on a year-over-year basis, let's say for instance, right, we're going to be, let's say like in the June quarter and July quarter of 2023. Now we're talking, you're going to be comping against energy prices that was like nat gas $7, $8, $9. You're going to be comping against oil that was $120+ a barrel. And are you going to see those sorts of prices again next summer? I don't know. There was a bunch of freak kind of things happen there all simultaneously that essentially made oil spike super high in this insane bull cycle and not just oil, but a ton of commodities. Are we going to get that same crazy level of a bull cycle again next year? I think that's very, very questionable. And energy is the biggest component really of inflation kind of going out of control because not only is it the price you pay at the pump and those sorts of things, but it's also transportation of goods around for companies. It's made, the cost of doing business just much more expensive. And it's hurt several of my companies. It's hurt almost any company that has to transport product around at the end of the day, okay?
I mean, without a doubt, the most bullish scenario is, guess what, we just had the recession. That's certainly an arguable point right now, but having had one or just noticing one is usually a bullish spot for the market, so you can't say we're there yet. Now, if the Fed remains behind and you therefore expect the Fed, as officials have been saying, to remain pretty vigilant and just focused on getting rates higher and restraining demand and perhaps muting the strength of the labor market, can we not also interpret the market as saying that's fine, but the economy is now perhaps sturdy enough in the short term to absorb that? In other words, the soft landing scenario, it seemed pretty much a long shot a little while ago, maybe a little bit less of a long shot now. So that you think is wrong-headed as well?
Yeah, so I think, Mike, what that misses is that's kind of the traditional soft landing. And what that misses is that we are in a historically tight labor market. And so, some people have said we can't be in a wage and price spiral because wages aren't rising as fast as prices. So if prices go up, that chokes off demand. Well, what's happening with a very tight labor market is that workers can now argue for more raises to try and regain their purchasing power. So instead of a wage and price spiral, maybe we're in a price and wage spiral, maybe chicken and egg, right? But whatever, it argues that this persistent inflation backdrop is going to stay, that the soft landing works when you have a lot of excess labor, you have a lot of slack in the economy, and that slack exerts disinflationary forces on the economy. I just don't think we're there right now.
It's interesting, I think it's going to be hard. It depends on what industry you're in. It depends on many various factors. If you're talking about any type of major increase in your wages in 2023, we've already heard the biggest of the big tech companies already come out and be pretty aggressive with their workforces about, hey, you need to get back in the office, or, you need to have these certain performance metrics hit, or you're out. So I think because of the change in the, let's call it economy, and a major softening of the economy, right? That has caused companies to kind of look at things and be like, we don't need to hire as aggressively. Look at how many companies have announced they're either freezing hiring or limiting their hiring. They're doing it in a massive way, right? Plus you have layoffs going on right now. So I think it's going to be very, very difficult to get any sort of major wage bumps. Let's just call it over the next 6 to 12 months, at least in my personal opinion. We're not in that sort of environment right now, in my opinion. Even though unemployment's low, I think they'll just kind of look at it as, you don't want to work here anymore? Bye-bye. You're doing us a favor. I think that's the way a lot of these companies will look at it in a softening environment, right? So I think that's just kind of some food for thought there. It's obviously a messy situation. Okay, let's get into this one and let's hear what they have to say here.
Course with a recession. Peter Bookbar is the Chief Investment Officer at Bleakley Advisory Group and a CNBC contributor. Peter, good to have you with us. You say there's 3 stages in a bear market. We're only in the middle right here.
Right. So the first one is a valuation adjustment, which we clearly have seen. The second one is the economic impact and also the earnings impact of a slowdown. And then the third one is when everyone throws in the towel. And I can argue that we're really just beginning the first phase of part number 2, where growth is slowing and we're beginning to see the impact on earnings, particularly profit margins. And I think this still has a ways to go to work through door number 2.
Peter, it's Tim. So independent of
Interesting. Okay.
necessarily what they're going to do, what do you want the Fed to do?
By the way, the other guy looked like he was in 2005, with his little ear thing. This guy looks like he's 2012 squad here with the wired up AirPods. They didn't even call them AirPods back then. Would they call them earpods or something like that? Hey, shout out if you still use the wired ones, man. That's cool.
You're someone that's been critical for a long time about the Fed's transitory language and other such folly. And so wouldn't it be great news to see the Fed continue to hike and push us into recession? I'm kind of teeing you up for the answer that may not be the one you want to give.
Well, I think Powell wants to get to 3%, which he'll get with a 50 basis point increase in September. And then he can even calibrate it down to 25 basis points thereafter. So I don't think there's necessarily the right level of the Fed funds rate that's going to get to some magic level of lower inflation, because we just don't really know once you get above 3. Because when you look at previous rate hiking cycles, it was lower and lower levels of a Fed funds rate that started to break things. It was 2.25, 2.5 that did so in the fourth quarter of 2018. And previously it was higher than that, but each successive rate hiking cycle ended before the previous one because something broke. So now we start getting into dangerous territory.
The point I just want to make is don't forget stimulus money is coming. If you didn't know, a lot of states, including the biggest one in California, basically have stimulus programs that are coming in the fall, and folks are going to get different amounts of money depending upon many various factors. So just do keep that in the back of your mind. No one's even really talking about that. That's not like I watch a lot, quite a bit of CNBC. I don't really see many people even bringing this up. So this is just something to keep out there, that we're likely going to see a decent flood. I don't want to call it a massive flood, but a decent flood of stimulus money start to come out. And this was supposed to be to help inflation, right? Which you could make an argument that it actually, hurts in that whole situation. Could make things more inflated, right? But just do keep that in mind. Stimmy money is coming, and is coming very shortly here.
Where things are at risk of breaking. But the important thing also is this balance sheet reduction that is only barely just begun. And I still like to separate out the interest rate increases that impact negatively the interest rate sensitive parts of the economy, like housing that we saw today, and it's already slowing autos. And then QT, which will have a direct impact on financial conditions and the markets. And I think Melissa made a great point just before, saying that the markets really are playing a game of chicken with the Fed, but it's the same playbook. Oh, maybe the Fed is going to be done raising interest rates soon because inflation is topping out, therefore you got to buy. And I think people are not being sensitive enough to this economic slowdown and what it's going to mean for corporate earnings and profit margins.
Okay, before we get into that, yeah, the big ticket purchases, which I always think about is housing, right, and cars. That's usually the two things people spend the most money on. Both those are in a really, really tough dynamic for right now and for honestly probably the next 6 to 12 months. Reason being is interest rates going up a ton, right? Secondly, confidence extremely low. Consumer confidence is around the lowest we've ever seen. And so, if you're talking about those sorts of big purchases, you need people to have high confidence. And generally speaking, you want to have low interest rates. We're not in that situation at all right now, and that could make it obviously a very tough dynamic. We're already seeing that in housing the past several months. It's just getting worse and worse, the whole housing picture. We'll see when the bleeding stops. I don't think it's going to stop this year. I think the most realistic possibility at the earliest is 2023 or maybe 2024 when it comes to housing. Auto's probably similar.
Hey, Peter, Jeff Mills here. So based on this environment that we're describing, how would you tell our viewers to be positioning right now? I mean, are you still looking to play the momentum of some of the growth stocks that we've seen lately? Is it more on the value side? Where do you think the opportunity is?
It's more on the value side. I'm still pretty bullish on commodities generally, acknowledging the pullback because of worries about the demand side, but still very bullish on the supply side challenges. And I think value is still going to well outperform growth. I think the valuations in growth stuff, even with these declines, are still rather expensive, where there's still a lot of...
I see my silver, baby. Oh, yeah, I love some silver.
...gotten value names that have already have lower expectations already embedded in them.
Peter, great to see you. Thanks. Peter
Thank you.
I don't know about being bullish on commodities.
I love Peter's work, and I've followed it for a very long time. I would say this, though. The but is this.
Okay.
If we're done going down, let's say we have another test like somewhere like 3,600, 3,700 or whatever, and then everything holds, right? The same stuff that I think led us in the last leg of the bull market, I think is the stuff that's going to lead. Like, I'm not going to want to go to value. I'm going to want to go to perceived value, the sort of like stocks. I think those, but I think it's the stuff that's down 60, 70, 80%, the quality names, like a PayPal, some of the names that we've been talking about over the last few months. I just think that's where you're going to get a lot of bang for your buck.
Well,
and that
not value.
No,
I agree.
Not value. But what I'm saying is I don't want to go to energy. I don't want to go to financials or home builders or stuff like that. I want to go to the stuff that was working really well in 20.
I agree. And also, by the way, if we're going to have a recession, that's not good for the whole energy space. And the way they keep, almost every single week, there's more and more rigs, because it's still very, very profitable if you're drilling right now. So I agree with him. If we do get any sort of major move down again, you got to buy growth stocks. Like, bottom line, if you get a major, another, let's call it down tick here, you got to get in growth, man. And that could be stocks like PayPal, that could be stocks like Shop, whatever.
21, the stuff that I think is going to be around in 3, 5, 10 years.
Yeah, Jeff, you still make the case for big cap tech as defensive?
Yeah, I think so, honestly, because if you're thinking about financials or industrials or materials, like, that's not what's going to pop if, in fact, inflation continues to go down and the Fed at least gives some signs of slowing down. So I think you do want to focus on those quality growth names. I still really believe that you're going to see a reduction in earnings expectations for next year, even with the reduction in expectations we've already seen. So I think you want to be in those names, like Dan said, that have already seen that multiple compression, that are going to be able to maintain some semblance of earnings growth. I really think that's where investors are going to be looking for value as we move into the end of the year here.
Now, something I think is very important there is, did you hear how confident everybody is? And you're going to find this, the Wall Streeters are all in agreement here that essentially almost all of them are expecting earnings to continue to go down for pretty much the remainder of this year and into 2023. Okay. Now, if the far majority of these Wall Streeters are expecting that, and that does not happen, that leaves enormous potential upside in 2023. We'll see what happens there. But, like I said, I watch a good amount of these folks come on there, these Wall Streeters, and they're all talking like so confidently about believing earnings are going to continue to deteriorate. And if that doesn't happen, and maybe let's say the Fed isn't as aggressive because let's say inflation rate of growth slows substantially, that leaves an absolute kind of banger rally in 23. So I'm not predicting that. I just stating the facts and kind of how these things work. Okay. Hope you guys enjoy this. As always, thanks for being here on the new channel. By the way, if you want access, I actually have a couple free stock courses right now. If you're at all somewhat newer to the market, or maybe you've been in for a year or two, these courses will help you. They're absolutely free to access. You can get on the phone with somebody from my team. They'll get you enrolled in those. You don't have to buy anything or anything like that. You don't have to join the prep stock group to get access to those 2 courses. And they'll just ask you some questions, get you enrolled in whatever is the best one for you. That is pinned comment if you want to access that. Much love as always. Thanks for being subscribed here. Less than 7,000 subscribers, and have a great day.